Good morning, everyone. Today is Friday, the 27th of March, 2026. We're tackling a critical, high-stakes question that no one wants to face, but one we must prepare for. How do you protect your wealth if Iran is invaded today? An invasion of Iran isn't just a geopolitical crisis, it's a financial earthquake that will ripple across every corner of the global economy. Oil prices will spike, markets will swing wildly, currencies will fluctuate, and your hard-earned savings could be at risk. But here's the good news: with the right strategy, the right mindset, and immediate action, you can shield your wealth from the worst of this chaos. Over the next 15 to 20 minutes, I'm going to walk you through a step-by-step, actionable plan, from the first 72 hours to the weeks that follow, to ensure your financial security when crisis strikes. This isn't fear-mongering, it's preparedness. And in times of uncertainty, preparedness is your greatest asset. Let's dive in. First, let's understand why an Iranian invasion would be so disruptive to global wealth. Iran is not just any country, it's a major player in the global energy market, controlling the Strait of Hormuz, a narrow waterway through which 20% of the world's oil passes. If that strait is blocked or disrupted, oil supplies will plummet, and prices could skyrocket to $120, $150, or even higher per barrel. That's not speculation, it's history. When tensions rise in the Middle East, oil markets panic, and inflation follows. Add to that the geopolitical uncertainty, sanctions, capital controls, and market sell-offs, and you have a perfect storm for wealth erosion. But panic is your enemy here. The key is to act quickly, but calmly, and focus on three core principles: liquidity first, diversification, and protection against inflation and market volatility. Let's start with the most urgent phase, the first 72 hours after an invasion is announced. The first 72 hours are make or break. This is when markets react most violently, and liquidity dries up fastest. Your number one goal here is to secure liquidity, cash and assets you can access quickly, and reduce your exposure to high-risk investments. Let's break this down into four critical steps. Secure your liquidity is the first one on your job list. Liquidity is king in a crisis. You need cash on hand to cover essential living expenses, to take advantage of market opportunities when prices drop, and to avoid being forced to sell assets at a loss. So, how much cash do you need? Aim for 3 to 6 months of essential living expenses, rent or mortgage, utilities, food, medicine, and other non-negotiable costs. But not just any cash. Hold this money in highly stable, globally recognized currencies. The US dollar, euro dollar, Swiss franc, and Japanese yen are considered safe havens because they're backed by stable economies and central banks. If you're in a country with a volatile currency, converting a portion of your savings to these currencies is non-negotiable. Additionally, keep a small amount of physical cash at home, both local currency and a foreign safe haven currency, for emergencies. What if ATMs go down? What if banks limit withdrawals? Physical cash ensures you can buy essential supplies when digital systems fail. For the rest of your liquid cash, park it in short-term, low-risk vehicles, short-term treasury bills, money market funds, or high-yield savings accounts. Avoid long-term lockups like CDS or fixed-term deposits. You need to be able to access this money in 24 hours or less. Secondly, reduce exposure to risk assets. Now is not the time to hold on to high-risk, high-volatility investments. You need to trim or hedge positions that will be hit hardest by an Iranian invasion. Let's list the assets to avoid or reduce. Growth and tech stocks are first on the list. These stocks have high valuations and are extremely sensitive to interest rate hikes and market sentiment, both of which will turn negative in a crisis. Cyclical sectors, like travel, retail, and real estate, will also suffer. Think about it: if oil prices spike, Airfares go up, people cut back on travel and discretionary spending, and real estate markets slow down as mortgage rates rise. Emerging markets, especially those that are net oil importers, like India, Japan, and much of the EU, will see their currencies weaken and their stock markets drop. And finally, illiquid assets, private equity, real estate, collectibles, or any asset that takes weeks or months to sell. In a crisis, these assets become paper gains that you can't access when you need them most. One more critical point: avoid leverage at all costs. Margin calls can wipe out your capital in hours when markets are volatile. If you have any margin positions, close them immediately. This is not the time to gamble with borrowed money. And third, activate core safe havens. Now that you've secured liquidity and reduced risk, it's time to protect your wealth with assets that thrive in crises. The number one safe haven, without a doubt, is gold. Gold has been a store of value for thousands of years, and it shines during geopolitical turmoil and inflation. When currencies lose value, when markets crash, gold retains its purchasing power. You have two options here: physical gold or gold ETFs. Physical gold, coins or bars, is ideal because it's tangible, portable, and not dependent on banks or digital systems. Look for reputable dealers and store it in a secure location, like a safe deposit box or a home safe. If physical gold is not accessible, low-cost gold ETFs like GLD or IAU are a great alternative. They track the price of gold and can be bought or sold on stock exchanges in minutes. Beyond gold, consider defensive equities, companies that provide essential goods and services that people need regardless of the economy. Think utilities, electricity, water, consumer staples, food, toiletries, healthcare, pharmaceuticals, hospitals, and defense contractors. These companies have stable cash flows, pay consistent dividends, and are less volatile in crises. Finally, short-dated high-quality bonds, U.S. Treasuries, German bunds, or other sovereign bonds from stable countries. These bonds are considered risk-free because they're backed by governments, and they provide a steady return while preserving your capital. Fourth, follow the emergency taboos. There are 3 things you must not do in the first 72 hours: don't panic sell, don't concentrate your assets, and don't chase returns. Panic selling is how people lose most of their wealth, selling low because of fear, only to miss the recovery. Concentrating your assets, even in safe havens, is risky. If one asset class fails, you lose everything. And chasing returns by investing in high-risk assets during a crisis is a recipe for disaster. Stick to your plan, stay disciplined, and avoid emotional decisions. We've covered the immediate actions you need to take in the first 72 hours, but preparedness doesn't stop there. Once the initial panic subsides, you need a medium-term strategy to protect your wealth over the next 1 to 12 weeks. This phase is about building a war-resilient portfolio that can weather ongoing geopolitical tension, rising inflation, and market volatility. Let's break this down into 3 key areas: asset allocation, sector and geographical positioning, and currency diversification. How to make a medium-term strategy for 12 weeks. Building a war-resilient portfolio with a table of asset allocation. Let's talk about asset allocation at first. Your portfolio should be balanced to protect against inflation, market volatility, and currency risk. Here's a proven framework for a crisis-resistant portfolio: 25 to 35% in cash and short-term debt, 15 to 25% in gold and precious metals, 20 to 30% in defensive equities, 10 to 15% in energy and commodities, and 5 to 10% in international bonds. Let's explain each component. Cash and short-term debt, 25 to 35%. This is your liquidity buffer. It allows you to cover expenses, take advantage of market dips when assets are undervalued, and avoid being forced to sell assets at a loss. As I mentioned earlier, this should be in safe haven currencies and held in highly liquid accounts. Gold and precious metals, 15 to 25%. This is your inflation and currency hedge. Gold will continue to rise as geopolitical tension persists and inflation increases. You can split this between physical gold and gold ETFs for both security and liquidity. Defensive equities, 20 to 30%. These are the steady eddies of your portfolio. Companies in utilities, consumer staples, healthcare, and defense will continue to generate revenue even in a downturn. Look for companies with strong balance sheets, low debt, and consistent dividends. These are the stocks that will recover fastest when the crisis eases. Energy and commodities, 10 to 15%. An Iranian invasion will disrupt oil supplies, so energy stocks will benefit. This includes oil producers, oil services companies, and pipeline operators. Additionally, commodities like wheat, corn, and fertilizer will rise as food security becomes a concern. Geopolitical crises often disrupt global supply chains, and agriculture is no exception. International bonds, 5 to 10%. This is about diversification. By investing in high-quality sovereign bonds from stable countries outside your home market, you reduce your exposure to currency risk and credit risk. For example, if you're based in the US, adding German bonds or Japanese government bonds to your portfolio can protect you if the US dollar weakens. Then, sector and geographical positioning. Not all sectors will be affected equally by an Iranian invasion. Some will thrive, while others will collapse. Let's start with the sectors to overweight. Energy is the top priority. As I mentioned, Iran controls the Strait of Hormuz, so oil prices will spike. Companies that produce oil, provide oil services, or operate pipelines will see their stock prices rise. Defense is another winner. Global defense spending will increase as tensions rise, so aerospace companies, weapons manufacturers, and military tech firms will benefit. Agriculture is also a safe bet. Food security becomes a critical issue during crises, so fertilizer companies, seed producers, and agricultural commodity traders will see demand surge. Now, the sectors to underweight or avoid: airlines, shipping, and tourism will be hit hard by rising fuel costs. Airlines rely on jet fuel, which is tied to oil prices. Higher oil means lower profits and higher ticket prices, which reduces demand. Shipping companies face higher fuel costs and disrupted supply chains. Tourism will decline as people cut back on travel due to economic uncertainty and geopolitical risk. Highly indebted companies and sectors are also risky. Higher interest rates and inflation will squeeze their margins, making it harder for them to repay debt. Finally, avoid any assets tied to Iran or countries with strong ties to Iran. Capital controls, sanctions, or asset freezes could wipe out your investments. Geographical diversification is just as important as sector diversification. If you live in a country that's heavily dependent on oil imports, or a country with strong political ties to Iran, your assets could be at risk of capital controls or currency devaluation. Consider moving a portion of your wealth to stable jurisdictions, countries like New Zealand, Switzerland, Singapore, or the US. These countries have strong legal systems, stable currencies, and no direct exposure to the Middle East crisis. You don't need to move all your assets, just enough to diversify your geographical risk. For example, opening an international bank account in Switzerland or a brokerage account in the US can give you access to safe haven assets and protect your wealth from local economic instability. And third, currency diversification. In a crisis, currencies can fluctuate wildly. The US dollar will likely strengthen in the short term, but over time, inflation could erode its value. To protect against currency risk, hold a basket of safe haven currencies: USD, EUR, CHF, and JPY. This way, if one currency weakens, the others will likely strengthen, balancing out your losses. Avoid holding large amounts of a single currency, especially if it's from a country that's heavily affected by the crisis. For example, if you're based in the EU, which is a net oil importer, the euro could weaken due to rising oil prices. Holding USD or CHF can offset that risk. Before we move on to special cases, let's recap the 5 critical rules for wealth survival during an Iranian invasion. These rules will guide every decision you make, so commit them to memory. Rule 1. Liquidity yield. In a crisis, it doesn't matter how much your assets are worth on paper, if you can't sell them quickly, they're useless. Prioritize assets that you can sell in 24 hours or less. Rule 2. No single asset concentration. Don't put all your eggs in one basket. Spread your wealth across cash, gold, bonds, defensive stocks, and energy assets. If one asset class fails, the others will protect you. Rule 3. Physical assets have value. When banks fail, when markets crash, when currencies become worthless, physical assets retain their value. Physical gold, essential supplies like food and medicine, and physical cash are your last line of defense. Rule 4. Avoid panic selling. Volatility creates opportunities. The best time to buy quality assets is when everyone else is selling. Use your liquidity buffer to buy undervalued assets during market dips, but only if they fit your long-term strategy. Rule 5. Hedge inflation. An Iranian invasion will spark inflation, especially in oil and food prices. Gold, tips, treasury inflation-protected securities, and real assets like energy and agriculture will protect your purchasing power. Now, let's address a special case. What if you're currently in Iran, or you have significant assets in Iran? The rules here are different. Your top priority is to get your wealth out of the country and into safe havens as quickly as possible. Let's break this down into 4 urgent steps. First, exit the local currency immediately. The Iranian rial is highly volatile, and in the event of an invasion, it will likely collapse. Convert as much IRR as possible to USD, EUR, or CHF through stable, legal channels. Avoid black markets, they're risky and could result in losing your money. Second, move assets offshore. Use trusted international banks or brokers to transfer your assets out of Iran. Look for banks in stable jurisdictions like Switzerland, Singapore, or the US. These banks have strong privacy laws and are not subject to Iranian capital controls. If you have real estate or other physical assets in Iran, consider selling them quickly, if possible, and transferring the proceeds offshore. Third, physical gold is king. If you can't transfer assets offshore immediately, hold physical gold. Gold is portable, untraceable, and retains its value when fiat currencies collapse. You can carry small amounts of gold coins with you if you need to leave the country, and it can be sold anywhere in the world for cash. Fourth, prioritize survival. Wealth protection means nothing if you don't have your safety. Before worrying about your investments, secure food, water, medicine, and a safe place to stay. Once your survival is guaranteed, then focus on protecting your wealth. I know this all sounds overwhelming. The thought of an Iranian invasion and the financial chaos that follows is scary. But remember, preparedness is power. By taking the steps we've outlined today, securing liquidity, reducing risk, activating safe havens, building a crisis-resistant portfolio, and diversifying geographically and by currency, you can protect your wealth and even position yourself to take advantage of opportunities when the crisis eases. Let's do a quick recap to make sure you have the key takeaways. In the first 72 hours, focus on liquidity and reducing risk. Over the next 1 to 12 weeks, build a balanced portfolio that includes cash, gold, defensive stocks, energy assets, and international bonds. Avoid high-risk sectors and concentrate on assets that thrive in crises. If you're in Iran, prioritize exiting the local currency and moving assets offshore. And always follow the 5 critical rules: liquidity first, no concentration, physical assets matter, avoid panic, and hedge inflation. Before we wrap up, a critical disclaimer: this video is for informational purposes only. It does not constitute investment advice, financial planning, or legal advice. Geopolitical events like an Iranian invasion are highly unpredictable. Markets can react in ways that even experts can't anticipate. Always consult a licensed financial advisor, tax professional, or legal expert before making any major investment or financial decisions. Past performance of safe haven assets is not indicative of future results, and there is no guarantee that any strategy will protect your wealth in all scenarios. This video is designed to help you prepare, not to provide a one-size-fits-all solution. At the end of the day, wealth protection is about control. In a crisis, you can't control the geopolitical landscape, you can't control oil prices, and you can't control market volatility. But you can control your actions, your mindset, and your portfolio. By being prepared, by staying disciplined, and by focusing on the principles we've discussed today, you can weather this storm and emerge financially secure. Thank you for watching. Stay safe, stay prepared, and we'll see you next time. I am Eric from Market Meridian Finance.